my working hypothesis is that, let's say Walsh cuts rates, we may never see a rate rise again, right? We may never see one again because of the massively deflationary pressure of what's happening and the rise in productivity. And that, yes, liquidity, we'll come on to liquidity in a sec, will get withdrawn because we don't need to roll as much debt. Market goes sideways for a while. The late 90s were exactly this. And what happened was, you get periods of consolidation that last a year, but nothing really went down. Nothing really blew up. Yes, we had the Asian crisis in the middle of it, but it didn't last very long again. It just kind of, it was a V shape and then it went straight down and came back up again. It feels like that is the environment we're going into. And I still think if that's the case and people are still late in this, the true bubble cycle comes next. So like 2028 onwards, it just sucks in everything.
Raul Pal, CEO of Real Vision and one of the most widely followed macro thinkers in global markets, lays out a hypothesis that sounds almost absurd at first hearing. A world where rate cuts could mark the end of traditional tightening cycles, not the beginning of another round of hikes. If you're like most people watching this, you might already be pushing back. Rates never rise again? That can't be serious. But Pal's argument isn't built on optimism. It's built on structural deflation, productivity expansion, and the idea that liquidity dynamics are evolving in ways markets have seen before, just not at this scale. And here's the uncomfortable part. If that framework is even partially correct, what many investors still describe as a bubble environment today may actually be the early stages of something much larger. Pal suggests the true mania phase, the kind that pulls in everything, could sit years ahead, not behind us. So the real question becomes, are we late, or are we still absurdly early? Before we go deeper into this discussion, where Pal connects policy, productivity, liquidity, and a potential multi-year expansion cycle, take a second to like the video and subscribe. And as you watch, I want you to keep one thought in mind. What if the market environment you've been fearing is actually the setup phase? Let's dive right in.
It profoundly looks like the Greenspan year playbook is A, what the government wants, and B, what is happening. So I look back over that period, productivity exploded, core inflation went nowhere, GDP growth exploded. What did Greenspan actually do? Nothing.
Yeah.
I mean, he did nothing over that whole period, really. And so that's, I think, what Walsh will do is nothing, cut rates and then sit on it and let productivity lower inflation. So inflation's not a problem, and let the economy run hot, which is what Trump's been saying, which kind of helps them reduce the debt to GDP or at least keep it stable. And that seems to be the playbook. And that was, if anybody remembers, a stunningly good cycle for almost all equities, not just for internet companies. And so I see that. Then I also see what you're saying about the business cycle picking up. And if this compute intelligence idea is the key defining idea of our times, then the right thing is, okay, well, people are moving down to the Capex cycle in cyclicals, the mining of stuff, the stuff that goes into making this. I've talked about solar. It's going to be a big part of this. And that's the part that actually is driven by the business cycle. So we should see that. And we're starting to see that catch up. You've been on those trends as well for a while.
Mm.
So we end up with a barbell where the intelligence side of the equation keeps going up and the energy side of the equation, the input side of the equation goes up now and plays catch up. If I'm right in my hypothesis that everything is this process of turning energy into intelligence, then you've got two multipliers. The US is leading intelligence and China is following. China is leading energy, but the US has all the oil and gas. So it's starting from a higher base, but China is ramping up faster. There's two dials to move here, I think. And I think the US solar is growing stupid fast as well, coming out of here in Texas. So I don't think the US will ever catch China in solar, but China doesn't have actual oil in the ground. The US has that. So I think it's to do with total base load and the rate of change increase in that, and then the cost per unit of energy, because that has to come down for everything. And solar's doing that. And then how much intelligence you can get out of it. Now, China's leading in terms of robots. That's clear. But probably not, well, it's not leading in terms of AI, but it's not a million miles behind. So that's the race. I mean, this is the biggest race of all time.
Yeah, probably the reason why they're decoupling on everything physical, right? They just have to, because this is an arms race.
It's an arms race, and with an aging population, don't get a choice either.
No.
And I've argued that this is what Japan is doing as well, that Japan is normalizing how its system works, because it was all run by the central bank and the MOF. And now they're letting the banks run by steepening the yield curve so the banks can earn a profit, so the banks can start lending. Because the only way of building out the capex required for the automation revolution, which Japan is part of, is they need capital. And it won't come from the central bank. It has to come from the banking system itself, which hasn't been lending in decades and has to relearn that muscle. And I think that's what's going on. They're renormalizing the economy to allow the banks to reliquify and to then lend to fund a capex boom. You know, what's weird is how macro now has become this whole conceptual thing, because we're having to go through the biggest period of change. Humanity, the global economy, everything's ever gone through. Macro's job is to see it in advance. So we're much earlier generally than others. Yes, the technology industry obviously knows it because it's building it, but so few others really yet get it. And so when people talk about a bubble, it's not a bubble. If I speak to any of my friends, they have no idea about any of this stuff. None of it. We're on X all day looking at people building stuff on Clawbot going, oh my God, how do I... I met a friend of mine from Coinbase, happened to be at an airport yesterday, and I'm like, what have you been up to? He's like, oh, in my spare time, I'm building Clawbots, and I've got one running my company, and I've got one in a startup that I invested in as employees running all of this shit. I speak to my friends, they've got no clue. I mean, zero clue. And these people are now, because they're all in their 50s, in senior positions in senior companies. They have no idea what's happening. So outside of this kind of mega trend that's kind of complicating it for everybody, business cycle wise, you just think, okay, the business cycle expands from here. It continues to expand till whenever, whether it's into the end of the year or into next year. The political fiscal cycle in the US keeps driving it. Just going into the business cycle side, what's your view on all of that?
So first of all, I think it was a game changer that we got this reintroduction of the bonus depreciation in the one big beautiful bill. It basically means that you're incentivized from a tax perspective to do capex now rather than later. We've obviously seen the first signs of that in the quarterly reports from Alphabet and Amazon, etc. Right? That they're spending big this year, but it also shows up in the capex expectations for smaller companies now, which is probably the big game changer relative to last year. So this is a capex year, also outside of the Max 7s, and that obviously means that we're also approaching the part of the cycle where everything from oil to industrially linked commodities will start to thrive. We've seen the first signs of that in the energy space since New Year's. You've seen great returns if you've invested in some of the oil companies, and I think that will keep going through the year.
What makes Pal's framework particularly interesting is how it reframes something investors usually interpret negatively: massive capital expenditure, particularly the ongoing AI Capex injection by major technology corporations aiming to dominate AI infrastructure. Traditionally, falling free cash flow raises alarms. It triggers concerns about excess, misallocation, bubbles. But Pal views the current capex surge through a different lens, one tied to productivity cycles rather than speculative excess. This is where his thinking subtly overlaps with analysts like Lynn Alden, and even elements of Eric Brynjolfsson's work on technology-driven productivity waves. Periods of heavy investment often look messy in real time. Earnings compress, margins wobble, valuations feel stretched. Yet historically, those same periods frequently precede expansions, not collapses. The key distinction isn't whether companies are spending, it's whether that spending ultimately compounds economic output, and that naturally raises the next critical piece of the puzzle. If productivity and capex are accelerating, what happens to liquidity?
My working hypothesis is that, let's say Walsh cuts rates, we may never see a rate rise again. Right? We may never see one again because of the massively deflationary pressure of what's happening and the rise in productivity. And that, yes, liquidity, we'll come on to liquidity in a sec, will get withdrawn because we don't need to roll as much debt. Market goes sideways for a while. The late 90s were exactly this. And what happened was, you get periods of consolidation. that last a year, but nothing really went down. Nothing really blew up. Yes, we had the Asian crisis in the middle of it, but it didn't last very long again. It just kind of, it was a V shape and then it went straight down and came back up again. It feels like that is the environment we're going into. And I still think if that's the case and people are still late in this, the true bubble cycle comes next. So like 2028 onwards, it just sucks in everything.
Again, if you look at the comparison to the run up to year 2000, what you saw ahead of year 2000 was a huge spike in returns in companies doing capex. We're currently seeing the exact opposite. And I would worry if investors started piling in big time into companies with a falling free cash flow. That's odd from a textbook perspective. Right now, we see the textbook reaction to capex, right? Free cash flow falls in Google, Amazon, etc., and investors, they pull out. That's nothing to worry about. I mean, it's certainly not a bubble when you see that kind of response in markets, right? If you see a divergence between free cash flows and return profiles, that's probably where you need to reconsider the whole thesis. But we're so far from that. I mean, nothing in terms of return profiles versus earnings versus capex resembles what we saw in the run up to 2000.
No, exactly right. So let's talk about liquidity, because that's obviously an important thing. How are you seeing liquidity right now? And we'll exchange notes on what we're seeing or thinking.
So I think it's important when you discuss liquidity to make a distinction between what I typically label as narrow liquidity. So the liquidity that is available for banks to transact with each other through the Federal Reserve System. And then the broader liquidity cycle, which includes, deposits from households, corporates, etc. Right? Yep. If we look at the narrow liquidity picture first, it remains slightly tight, to be honest, right? We've seen a couple of shutdowns, both the one in the autumn and then the brief one we had over the calendar term between January and February. And every time we see shutdowns, we get a reaction in this narrow money measure, typically labeled net Fed liquidity, right? I still think we're, say, at least 200, 300 billion away from comfortable levels in that metric. That is essentially why they undertaken these reserve management purchases of T-bills. They launched those in December, the Federal Reserve, to try and avoid these hiccups in the narrow liquidity between banks. And we're slowly but surely getting there. Also, if you look at the most recent week, they've ramped up purchases. They're running roughly at 20 billion a week now, which is a lot, right? We're talking 80, 100 billion a month, almost on a trajectory basis now, which compares to, almost the peak of the COVID purchases, right? It's not too far off that kind of level. So the Fed is aware of that issue. They're trying to bring the structural liquidity back to an acceptable level. They've been told by all bank treasurers that they needed to add liquidity, and they've done so, and they're still doing so. The big question is whether Kevin Walsh and his whole school of thought will continue with these purchases once he's in office. But I actually think they will. And the reason is the following, right? We've seen hiccups in SOFR interest rates, repo interest rates through the autumn of last year into this year as a consequence of this tight structural liquidity between banks. I think they want to avoid such hiccups at all costs ahead of the midterms, right? Why would you run the risk of having hiccups around the quarter turn of October, for example, due to a tight liquidity landscape between banks just ahead of that election? So in that sense, I think it's pretty safe to say that they'll continue these reserve management purchases towards the end of the year. 2027 may be a different discussion. On top of that, I know Kevin Walsh has been, an advocate of a smaller balance sheet, a Federal Reserve balance sheet, that is, for a long time, and he's probably still thinking that it's doable. Let me stress this and underpin this and underscore this as much as I can. You cannot shrink the Fed balance sheet more than what you've already done unless you allow the private sector balance sheet to expand a lot before that.
That's right. And I think that's what they do. That's what they want, right? I think the key focus is going to be bank lending, bank credit creation, all of that side of things. And And that's where liquidity comes from the broader measures of liquidity and not the narrower measures. And that was the ESLR changes as well, was kind of laying the ground for that to happen. The checks from the fiscal rebates are going to start coming through. And what that does is it goes straight onto, it comes out of the TGA and it actually goes straight into the bank balance sheets. And the banks then use that potentially for leverage. And it has a credit multiplier throughout the system. So when you increase the deposits in the system, deposits are the highest quality of capital the bank can have, it then, because it pays no interest on it, and then it just levers it up, does whatever it wants with it. Yeah. And they're about to give the banks, I don't know, $1 trillion or whatever the number is. I don't know how big the stimulus is in terms of rebates. That's a big deal. It'll draw down the TGA until the tax season comes, and then we've got a rebuild of some of that. So it feels like we're getting close, and we've got the ESLR changes. It feels like it's a very positive liquidity picture going forwards.
As we step back and look at crypto's performance over the past few months, what stands out isn't simply volatility, it's the nature of that volatility. Bitcoin and the broader crypto market haven't been collapsing in isolation. They've been moving in rhythm with global liquidity shifts, tech sector repricing, and investor reactions to changing macro expectations. The sharp pullbacks, while emotionally exhausting, resemble recalibrations rather than structural breakdowns. Corrections of this magnitude are uncomfortable, but within the context of emerging asset classes, they are far from unusual. What makes this cycle particularly fascinating is the backdrop against which crypto is consolidating. We're witnessing one of the largest capital expenditure waves in modern history, driven primarily by AI infrastructure, compute expansion, energy investment, and automation. This isn't speculative capital chasing narratives. It's long-duration capital being deployed into productivity-enhancing systems. And historically, periods like this tend to reshape markets in ways that aren't immediately obvious. Liquidity doesn't vanish, it migrates, restructures, and eventually amplifies new areas of growth. From that perspective, the current bear phase in crypto begins to look less like a traditional downturn and more like a transition period. Markets are digesting a massive shift in how capital is allocated across technology, infrastructure, and financial systems. Short-term liquidity fluctuations, shifting rate expectations, and risk repricing naturally create turbulence, particularly for assets like Bitcoin that sit at the intersection of macro and innovation. But beneath the surface, the structural foundations, adoption, institutional participation, and long-term positioning continue to evolve. Looking forward, the path from this environment to a major crypto bull market may not depend on a single catalyst. Instead, it may emerge from the compounding effects of productivity gains, expanding credit cycles, and liquidity finding its way back into risk assets. If AI-driven investment continues accelerating global output while deflationary pressures suppress runaway inflation, the macro environment could begin favoring assets designed for long-duration growth. In that world, crypto doesn't just recover, it potentially re-enters the cycle with entirely different momentum dynamics. And perhaps the most important takeaway is this: periods of uncertainty rarely feel like opportunity while you're living through them. Volatility clouds conviction. Sideways markets drain patience. But the larger cycles, the ones Raul Pal is pointing toward, tend to reward positioning, not reaction. The question isn't whether volatility disappears, it's whether the structural forces now unfolding ultimately compress risk premiums and reignite expansion across digital assets. If this perspective resonated with you, like the video, subscribe, and share your thoughts below. Are we witnessing a prolonged digestion phase, or the early framework of something much larger? Thanks for watching, and I'll see you in the next one.